How do you think investors should look at everything this week, the final trading week of the second quarter and the first half of the year?
Yeah, I mean, it's really interesting because we're in this environment where data is highly distorted, and so it's coming in kind of all over the place. There's still the possibility of a soft landing, a hard landing, or this kind of no landing scenario. And we've switched to data dependence by the majority of central banks, especially with the Fed pausing now. And so the market, it's not only trading off of what's happening in expectations for the Fed and other central banks, but it's highly trading this data that's quite volatile. So it's a very hard trading environment.
So I think a lot of people are saying that, including you right now. So a lot of volatility, a lot of different factors. So if you're going to talk to some of your clients or other people today, how would you position for the second half of the year?
Yeah, it's really hard because we're having this kind of euphoria within equity markets, especially the US equity market. And a lot of that has to do with AI and the tech rally. And that, in itself isn't hugely bubbly, I think, because we don't have the liquidity backing it. It's a good story, and there is potential for growth there. And so it's not completely unwarranted that we're having this kind of equity upside. And I think, with people underpositioned, the risk is that we get a melt up in equities. But at the same time, if a recession's coming at the second half of this year, it's very worrying for risk assets.
All right, so a lot of worry coming from you, coming from a lot of people. I want to talk to you about something a lot of people are looking at, it, the inverted yield curve. We're going to show it in a minute. Just for the viewers, the red part shows deeper inversion. As we've had deeper inversion over the past few weeks, what does that make you think about the second half setup? Are there certain sectors you would stay away from in this scenario?
Yeah, I mean, so the yield curve inversion for us is a telltale sign of recession, and it definitely depends on what part of the yield curve you're looking at. So the 2s, 10s, which inverted first, that's less of a sign of a recession. It's not been as accurate. But the 3-month 10-year, definitely, that has 100% accuracy, even when you have these kind of ambiguous ends to cycles where you weren't expecting the end, so like COVID. And the Fed's, preferred measure as well as the near-term forward spread, and that's also inverted. And so, the thing is, you don't know how far after inversion that you actually get recession. There's not a huge correlation to the deepness of inversion in terms of, deep inversion just tells you the market's expecting more cuts from the current point or growth to slow even more. So it doesn't tell you the exact timing. But what it does tell you is that, on average, 12 months after the 3-month 10-year inverts, you do get a recession. And so the longer you go without a recession being confirmed, the more worried you are.